Imagine waking up 10 years from today and realizing that the $500 you could have spent every month has quietly turned into a serious amount of money. No lottery ticket, no overnight success, no secret investment trick. Just $500 invested consistently, month after month. At first, it doesn't look impressive. $500 becomes $1,000, then $5,000, then $10,000. But here's where things get interesting, because when your money starts making money, the game completely changes. So what would actually happen if you invested $500 every single month for the next 10 years? Let's break it down. First, let's say you invest $500 every month into a diversified investment, such as a low-cost index fund. And for this example, we assume an average annual return of around 8%. That's not a guarantee because markets can go up and down, but it gives us a reasonable illustration of how compound growth can work over time. After 1 year, you've personally invested $6,000. Your account might be slightly more or less depending on market performance. Doesn't sound life-changing, right? And that's exactly why most people quit. They look at the first year and think, that's it? But investing isn't designed to impress you in the beginning. It's designed to reward patience. After 5 years, you would have contributed $30,000 of your own money. With an average 8% annual return, your investment could potentially grow to around $36,700. That means your money has generated roughly $6,700 in growth. You didn't work extra hours for that money. You didn't start another business. Your investment simply had time to grow. And this is where the first big lesson appears. The earlier you start, the more time your money has to work for you. Now let's reach the 10-year mark. You invested $500 every month for 10 years. Your total contributions are exactly $60,000. But with an average 8% annual return, your account could be worth roughly $91,500. That's more than $31,000 in potential investment growth. Think about that for a second. You put in $60,000, and time and compounding potentially added another $31,000 to the picture. And here's the part most people don't realize. You didn't need to be rich to get started. You didn't need $60,000 sitting in your bank account on day one. You simply needed to start with $500 and keep going. But let's make this even more interesting. What if you invested that same $500 every month for 20 years? Now you've contributed $120,000 of your own money. At the same hypothetical 8% average annual return, your investment could grow to around $295,000. Notice what happened. You doubled your contributions from $60,000 to $120,000, but your potential account value didn't just double. The power of compounding became much more noticeable. And now comes the part that can completely change how you think about investing. What if you kept going for 30 years? You would have personally contributed $180,000. But at that same hypothetical 8% average annual return, your investment could potentially grow to around $745,000. That's right. The difference between your contributions and your potential account value becomes enormous. The money you invested early had decades to generate returns, and those returns had time to generate even more returns. This is why compound growth is often called the eighth wonder of the world. Your money isn't just sitting there. Ideally, it's creating growth, and that growth stays invested and has the opportunity to create even more growth. It's like planting a tree. In the first few years, you might barely notice anything, but if you keep watering it and give it enough time, eventually the tree becomes much bigger than you expected. The problem is, most people want to dig up the seed every 6 months to check if it's growing. But there's something important you need to understand. These numbers are examples, not promises. An 8% average return isn't guaranteed. The market can fall. Sometimes it can fall dramatically. There can be recessions, crashes, inflation, and years when your investments lose value. If you invest $500 every month, you might see your account drop even while you're doing everything right. And that's where your biggest challenge may not be choosing the perfect investment. It may be controlling your emotions. Imagine investing $500 every month for 3 years. You finally reach $20,000 or $25,000, and then the market crashes. Suddenly, your account is worth thousands of dollars less. Your first instinct might be to panic. You might think, I'm losing money, I need to sell. But if your investment strategy is sound and your time horizon is long, selling in fear can turn a temporary decline into a permanent loss. This is why long-term investing requires something that doesn't show up on a financial statement: patience. Now, here's another question. What if you don't have $500 every month? Does that mean you're out of the game? Absolutely not. The most important number isn't always $500. It's the habit of investing consistently. Maybe you can invest $100. Maybe it's $200. Maybe you start small and increase your contribution when your income grows. The goal isn't to impress people with how much you invest. The goal is to build a system that you can actually maintain. Let's say you get a raise at work. Instead of increasing your lifestyle immediately, you increase your monthly investment from $500 to $600, then eventually to $700. Those small increases can make a huge difference over decades. This is one of the secrets behind long-term wealth building. Consistency beats intensity. You don't need to make one giant financial move. You need to make many good decisions and repeat them for a very long time. And here's the uncomfortable truth. 10 years can pass whether you invest or not. Think about where you were 10 years ago. It probably feels like yesterday. Now imagine that 10 years from now you look at your financial life and realize you could have invested $500 every month the entire time. The question won't be, why didn't I find the perfect investment? The question might be, why didn't I simply start? Of course, investing isn't the first step for everyone. Before investing aggressively, you should consider building an emergency fund, paying attention to high-interest debt, and understanding your own financial situation. And if you're investing for the long term, diversification and low costs can matter. The exact strategy depends on your goals, risk tolerance, and circumstances. But the biggest lesson is surprisingly simple. Wealth isn't always built through one huge opportunity. Sometimes it's built through ordinary actions repeated for an extraordinary amount of time. $500 might not feel powerful today, but invest it consistently, give it time, and allow compound growth to work, and that same $500 can become part of a much larger financial future. So, here's the question. If you had started investing $500 every month 10 years ago, where would you be today? And more importantly, where could you be 10 years from now if you finally started? Because the clock is moving either way. The only difference is whether your money is moving with it.